Good morning, everyone. My name is Wong Shiwei. My metric number is 308084. So now I will be presenting my individual report, The Terminus
of Ajinomoto Malaysia Berhad Performance.
Ajinomoto Malaysia Berhad is a publicly traded food manufacturing company and a subsidiary of the Japanese multinational Ajinomoto Company. The company was founded in Malaysia in 1961 and has been listed on Bursa Malaysia since 1968 under the ticker symbol AJI. The company obtained halal certification in 1965, which helped build trust within Malaysia's Muslim majority consumer base. Its products include Ajinomoto, Chumix, Seri Aji, Frozen Gyoza, and Aminovito. Now, let me explain the research problem. Ajinomoto Malaysia is currently undergoing a major strategic transformation, moving from a traditional MSG manufacturer to a modern food and amino acid corporation, including a transition to a new GBI-certified smart factory in Bandar and State. However, this transformation occurred amidst significant challenge, financial volatility between 2015 to 2024, a sharp profit decline in 2022 to 2023, a one-off asset disposal gain in 2024 that have made artificially boosted profits, rising ESG expectations, and the COVID-19 pandemic impacts. The raises a fundamental question: can Ajinomoto successfully balance its long-term sustainability goals with the immediate need for financial resilience?
So this is my research objective and research problem.
For the literature review, first on performance measurement, according to Mosh, profitability reflects a business' current performance and how effectively it manages its working capital. I measure performance using return on assets, calculated as net income divided by total assets. Second, on corporate governance, Cadbury defined it as the system by which companies are directed and controlled. Ritero explained that good governance builds investor trust. On internal factors, I examine three types of risk: liquidity risk, measured by current ratio and quick ratio; credit risk, measured by debt to income and average correction period; operational risk, measured by operational ratio and operating margin. On external factors, I examine market risk using four macroeconomic variables: GDP, inflation rate, interest rate, and exchange rate. For the methodology, my sample was drawn from Ajinomoto Malaysia's annual reports. The data covers a 10-year period from 2015 to 2024, making it a time series analysis. To analyze the data, I use a multiple linear regression analysis, employing the ordinary least squares OLS method via SPSS. This aligns perfectly with my three objectives, which I translated the three distinct regression models. Model 1 examines the relationship between internal factors and ROA. Model 2 examines the relationship between external factors and ROA. And Model 3 examines the combined effect of both internal and external factors on ROA. The descriptive statistics show that the mean return on assets, or ROA, is 0.1368 with a standard deviation of 0.1215. This indicates that, on average over the 10-year period, Ajinomoto Malaysia generated a profit of approximately 13.7% for every ringgit of its total assets. The standard deviation of 0.1215 suggests moderate variability in the company's performance across the 10 years, which is consistent with the financial volatility method earlier. Okay, now looking at the correlations, we can see several significant relationships. First, the operating margin shows a significantly strong positive correlation with ROA, with a correlation coefficient of 0.978 and p-value of 0. So this is a very strong indicator that higher operational efficiency is associated with higher profitability. This finding is consistent with higher, who stated the higher operating margins indicate more efficient midfield. Second, we see a significant moderate negative correlation between the debt to income ratio, coefficient of negative 0.552 and p-value of 0.049. This suggests that as the company's debt burden increases, its profitability tends to decrease, which aligns with the credit risk literature discussed earlier. Other variables such as GDP, inflation, interest rate, and exchange rate are not individually significant at the correlation level. In the model summary, we can see very interesting result. For model 1, which examines only internal factors, the adjusted R-square is 0.907, meaning internal factors explain 90% of the variation in ROA. Model 2, which examines only external factors, the adjusted R-square is negative at negative 0.535, indicating that external factor alone have no explanatory power. And most importantly, for model 3, which combine both internal and external factors, the adjusted R-square is 100%. This means that when we combine both internal and external factors, they explain all the variation in the company's return on assets over the last decade. Now we see the ANOVA table for model 3. The F statistic is 115.937 and the p-value is 0.014, which is less than 0.05. So the model is statistically significant. Okay, we see the coefficient table for model 3. The operating margin is far the most significant predictor with a p-value of 0.005 and a very strong positive coefficient. So this implies that for every unit increase in the operating margin, the ROA increase also. So this confirms that operational efficiency is the primary driver for Ajinomoto's profitability. And then we also see that the inflation and interest rate show a positive, moderate, significant relationship with ROA with p-value of 0.039 and 0.019. And the GDP and the exchange rate show a negative, moderate, significant relationship with p-value of 0.028 and 0.020. So this shows that higher economic growth and a weaker ringgit tend to reduce profitability. And last, the quick ratio and average collection period show a negative big significance, suggesting that excessive liquid assets and longer collection periods slightly reduce profitability. In conclusion, Objective 3 was successfully achieved. We found that when internal and external factors are analyzed together, they have a significant influence on Ajinomoto's performance. The company's profitability is overwhelmingly determined by its internal operational efficiency, especially its operating margin rather than external macroeconomic factors. While external factors like GDP, inflation, and exchange rates do have an impact, they are not as influential as the company's ability to manage its operation efficiently. This supports the company's current strategic direction of investing in its smart factory and operational excellence. Based on these findings, I have three main recommendations. First, the company should continue to maximize operational operational efficiency. They should fully utilize their smart factory capabilities, including the solar photovoltaic system and waste-to-bio fertilizer conversion, to reduce operational costs and improve the operating margin. Second, the company should improve credit management. Shortening the ACP period from approximately 51 days would enhance cash flow and reduce bad debt risk. This can be achieved by implementing stricter credit policies and streamlining collection procedures. Third, the company should develop a proactive macroeconomic risk monitoring system. Implementing hedging strategies could reduce the negative impact of a weakening ringgit on import costs. In addition, maintaining a diverse board with at least 30% women directors as recommended by the MCCG 2017 would enhance strategic decision making. So thank you for your time and attention. That's all from me. Thank you.